Okay, I think we're going to get started. I'm Doug Goldstein. Thank you very much for joining us here today for the 2025 Financial Survival Guide, which is really designed for helping retirees do well in 2025 because there's a lot going on that we're going to talk about today. And I'm very happy to be here with Ron Zalben.
Sounds great. I'm looking forward to speaking with you, Doug.
Ron, let's do this. Why don't we each introduce ourselves? You go first. Tell everyone here what you do and how you got started. If you want, you can
Sure.
include your favorite color.
I'm Ron Zalben. I'm a U.S. and Israeli CPA. I have 30 years of experience dealing with U.S. taxes and a little less on the Israeli side. I made Aliyah about 22 years ago from the States.
Okay. And I'm Doug Goldstein with Profile Investments. Also, been doing this for a little over 30 years. What I do is I deal with investments. I specialize in helping people who live in Israel handle their U.S. investment portfolios. And you might imagine that Ron and I actually work with a lot of clients in common because I help them on the investment side. He helps them on the tax side. And because all of our clients, but most of our clients are cross-border kind of people, meaning they live in one country, but they do have financial interests in the other. Things get sometimes a little bit more complicated, but nothing beyond what I've ever seen that either Ron or I couldn't solve. So this is the audience that we work with, and that's really who we're going to be targeting today's discussion. We specifically wanted to talk to people after the results of the U.S. elections so that we could really absorb some of the new information about what's going on, both in terms of investments and taxes. Obviously, nothing that we're going to discuss here today is tax advice or investment advice. You need to speak to your own licensed professionals. If during the course of this discussion, you have any questions you'd like us to answer, please fill in the information in the box on the side, and you can ask your questions. If we're not able to get to the questions during today's discussion, we'll try, but good chance we won't because we normally get a lot of questions. If we're not able to get to the questions, we'll try to respond to you after, hopefully within a few days. We'll try to get back to you. If they're long questions and very complicated, so someone on our team will be in touch with you to help you to arrange an appointment for a real consultation if you have any really specific questions. That being said, the topic about surviving 2025 is so important that I've also put together a guide about this that we'll be giving out to people for free who are not only attending the webinar today, but also people who are on our mailing list. If you want to be sure that you're going to get it, please just sign up now at profile-financial.com just to make sure that you're on the list, and you'll get a copy of the 2025 Survival Guide. Again, it's focused on retirees. It's going to include some of the information that we're talking about today, but it's also going to include other information. I think there's a lot that Ron and I have to discuss today. So the agenda for today is going to be, I'm going to dive in and talk to you about the investment side. Ron's going to talk to you about the tax side, and I hope that everyone gets a lot out of it. Ron, how does that sound?
Sounds great. Let's get going.
All right, here we go. Diving in. I'd like to pick up on a discussion which has probably been one of the most important conversations that I've had with every client over the past few years, which is inflation. And of course, I don't have prophecy, so I can't tell you what's going to happen in the world of inflation, but I'd like to give you some indication of what we've been seeing recently and maybe where that's going to go. So many of you may remember over the past few years, inflation got very, very high, probably much higher than you may even remember for decades, which is the way it really was. And one of the reasons why this is so important, especially for retirees, is because the numbers that they see in terms of what inflation really is are in fact kind of deceptive. And I'm not saying that anyone's trying to deceive you, but the numbers themselves can be deceptive. Now, you know the term, Ron, that we always talk about when we're talking about inflation, we talk about CPI, right? The Consumer Price Index. So the Consumer Price Index is basically a basket of goods and services that people pay for, and then the government measures all this and gives an average and says what inflation really is. The thing is, for retirees, it doesn't always apply. This kind of weighted goods and services basket doesn't necessarily apply to everyone. It really focuses on an urban population of all age groups, and it very frequently doesn't include the costs that are important for retirees, or it doesn't weight those costs. Most obviously would be things like healthcare, But your expenses are probably very different from someone who's 20 or 30. And even if they say inflation, not so long ago was 5-6% or more, you may have said, well, all well and good, but my costs are going up much faster than that. So what are we looking at now? We're hoping we've seen that slow down, right? The rate of inflation has actually decreased, and it feels a little bit better, and people are optimistic. But that being said, as the economy heats up and prices go up, so we could really see a resurgence of inflation. The policies that we're hoping for from the new administration will hopefully keep that under control. But people often say, well, the Biden White House or the Trump White House. It's true they have a huge influence on the economy, but it's not the whole story. There's a lot of other things that are going on. So even if you support Trump or you don't support Trump, or you think the policies are good or you don't think the policies are good, either way, it's not a guarantee that the changes in inflation are going to be something that you'll be able to control, or that the president can control. So you really have to begin to think about how you can control things yourself. We'll talk about that in a minute, but I want to just comment on something that I say a lot when I when I bring this up with clients. One of the things they say to me frequently is, yeah, Doug, but look, my Social Security is going up with the COLA increase, COLA, the cost of living adjustment. And Ron, have you been seeing people talk to you about that and the increases that they got, which seems sort of above and beyond?
Absolutely. The question is, does that take care of all the increases in food, healthcare, and anything else that a retiree would need?
Yeah, and unfortunately, I think that it doesn't. I think that a lot of people are saying it's very nice, and no one's complaining about getting more money, but
No.
they really do need a little more. So the expression to add insult to injury.
Oh yeah.
So let's apply that here. So first, this was the insult, the inflation insult, and now let's add insult to injury, which is what happens with interest rates. So also, people may remember very, very recently, they were getting really nice returns on their bank deposits or bonds. Rates could have been well over 5%. And then the Fed started to lower interest rates. And what's going to happen in the future? What's going to be going in 2025 in terms of interest rates? Let's just discuss for a minute how interest rates really change. Basically, the way interest rates change is when the Fed, the central bank in America, which kind of leads the whole world, but most major economies have a central bank. In fact, central banks were designed originally because governments needed money, and they said, what's better than having a central bank that can constantly lend us money? And that's sort of where we are today with the US and many, many, many other Western countries being heavily in debt. So the central bank decides where they want interest rates to be. And in theory, the central bank is an independent body that is not political. I can hear people laughing because a lot of people feel is very political. And one of the tools that they can use is they can lower interest rates. And what sometimes happens when they lower interest rates is it shoots up the stock market. And Ron, I'll ask you, have you seen this happen? And do you know why that usually happens?
No, why? I've definitely seen people's interest shooting up in the last couple of years. That's for sure.
Right. So it went up a lot. And then before the election, when the Fed started lowering interest rates, we saw the stock market go up because people began to say, and these were phone calls I had regularly, they'd say, Doug, I had a 5.5% CD. It came due, and now I can only get 4.5%. Not quite as exciting. Why don't I begin to put the money in the stock market? Or they say, I anticipate the interest rates continuing to drop. And they're not just anticipating, it's because literally the Fed said they were planning on lowering interest rates. And so people have to decide where to put their money. So they say, okay, maybe I'll just take the money out of the bank, and I'm willing to take more risk because the yield on the bank deposit isn't as great as it was a year ago. And therefore, I'm willing to take more risk. And so they start buying stocks, and buying, right, when more and more people buy stocks, that tends to push up the price of stocks, and that pushes up the stock market. So there is a theory that the Fed was lowering rates before the election in order to show how well the stock market would do under the previous administration. But there could be many, many other reasons for that. So I'm just pointing out it's very hard to know. And once again, I joke that you're adding insult to injury with both inflation and a drop of interest rates. But at the end of the day, I want to give you a couple of takeaways here. And again, let me remind you that we're going to be discussing a number of ideas. None of this is specific personal financial advice or tax advice. Make sure you speak to a licensed advisor. And if you want more about this, make sure you sign up to get the 2025 guide, which is designed for retirees, and just sign up at profile-financial.com. Make sure you're on the list to make sure that you get the guide. So what are some of the strategies that people are doing? The first one, which if you've ever read anything I wrote or heard anything, it's not just me. What all financial professionals like to talk about is the importance of diversifying, not putting all of your eggs in one basket. And I often joke that this was probably the advice that your grandmother gave you when she was teaching you a little bit about finance. And I always tell people, yeah, it was in fact the advice that my grandmother gave me, to not put all my eggs in one basket. But the funny thing about it is that she came to the table with the true air of authority, because my grandmother was one of the first women in America to be licensed as a stockbroker. So I actually took her financial advice very seriously. Nice. Let's assume for a minute that we're going to see some inflation in 2025, which I think is a fair assumption, and that we're going to see interest rates dropping, I don't think precipitously. And again, I'm not using prophecy. I'm just using good old-fashioned guesswork and what I think is going on in the economy. But I think they could be going down. So one of the things that you can do is to put a piece of the portfolio in the stock market. Now, of course, this depends on your tolerance for risk and your overall situation, but generally, stocks outperform inflation. So if you're a long-term investor and you can stand the volatility, having a piece of the pie, let's say in index funds and a broadly diversified portfolio of stocks, could probably help you out to keep ahead of inflation. Now, at the same time, you'll need something in fixed income, which could be CDs, bank deposits, and a CD stand is a certificate of deposit. That's the term we use in America. An FDIC insured bank offers CDs, certificates of deposit. You know your money's safe. You know you'll have a fixed interest rate on that CD. And in a minute, I'll tell you a strategy for how I think people should invest in CDs. You might even say, well, what about real estate? There are a lot of ways of buying real estate. A lot of times I found retirees don't just want to buy another apartment and rent it out, because then actually you have to deal with that. And let me just take a second to drink my coffee. And Ron, could you just comment on some of the tax issues people have to think about when they literally own an apartment and they rent it out?
Absolutely. They're going to have to pay taxes both to the United States and to Israel, and depending where that apartment is, and also potentially state tax if it's in one of the states in the United States. And depending where it is, the first right of tax for an apartment in Israel would be to Israel, and then America would have a remainder right, or the opposite. If it's in the States, America and the state would have first right to tax, and then Israel would have a remainder right.
Yeah, okay. So you'll definitely need to be dealing with the taxation on it. One of the tools that a lot of people use on Wall Street and is what's called a REIT, R-E-I-T, a real estate investment trust. It can kind of be described as a basket. Everyone puts his money in, and then they buy real estate. There's all sorts of different types of real estate they might buy. They may buy nursing homes. They may buy malls. They may any of a number of different types of real estate, or in fact, cell towers, right? There's all sorts of options. And then they pass through most of the income in the form of dividends. If someone owns a REIT in his portfolio, or a fund, the mutual fund that consists of REITs, does he have to file both in the U.S. and in Israel? Is it the same sort of thing where you're going to be dealing with, like you deal with real estate the way you just described?
Absolutely, but it's different because it's treated as dividends and not a rental property, and there are different rules. Actually, it sounds like a great idea to go into a REIT because you don't have the headaches of actually managing the property as you do as a landlord.
So if you get from the brokerage firm, your client says, Ron, Doug gave me the 1099 for my brokerage account, and it shows that I had $10,000 of dividend income from my real estate, and I had $8,000 in interest income. You just put that on the tax return?
We do. And it's just a little simpler than if you have a rental property, because the rules are more complicated, both in the States and in Israel.
Got it. I like simplicity. I'm always a big fan. Other simpler ways of getting involved in income producing investments and sort of in between, right? If you're concerned about inflation and therefore you want to have some growth, and on the other hand, you need to have some income. So you might look at investments like dividend paying stocks, or I would prefer, just because I like diversification, like my grandma told me, dividend paying stock ETFs, an exchange traded fund, a fund Again, it's just a basket and everyone puts his money in. And the managers buy stocks which pay higher dividends than normal companies. So now you're getting the dividends. At the end of the year, the brokerage firm is going to produce a 1099 for you, send it off, you hand off to your accountant. And then once again, Ron, I assume it's the same thing as far as you're concerned, dealing with the dividends from a dividend paying ETF or a REIT or a stock.
Correct. Correct. And again, you don't have the hassle of having to manage the property.
Yeah, again, I'm a big fan of.
I have clients that have had stories that you wouldn't believe of just the hassles that they have to deal with in managing properties.
Right. And one of the interesting things, it's not that I'm against property. If you're a real estate agent listening to this, I own a property, right? But that being said, it can be a hassle. And, a lot of times people say, yeah, but you get the rent every month. And especially for retirees, that's like getting a second pension. All well and good until the renter leaves or until you really like the renter and you keep renting to this family for years and years and you never raise the rent because you feel bad about it. And then what was once paying you 2 or 3% in terms of a yield on your property might be paying you 0.5% or 1% because you don't raise the rent. Because it's hard. It's an emotional connection you have with people. I will tell you, I've never had a single client who owned REITs who said, I really love those people who are renting out these properties that I have no idea where they are because it's a diversified portfolio of real estate. That never happened. I mentioned before, I wanted to give you a strategy for investing in CDs, certificates of deposit. And by the way, this strategy also could apply to bonds. I'll just define, just to be clear what this is. A bond or a CD is basically a loan that you make to a company. It could be to a bank or to a regular company, or if you lend money to the US government, that's called a treasury bond. You're lending them money and they promise to return all of the money to you plus interest. Now, that promise is only good as the issuer. So if you buy a treasury bond, you're lending money to the US government, and they're a pretty good bet. I think they're not going to default. If you buy a CD, that's like lending money to the bank. And the CDs, at least all the ones that we deal with, are insured by the FDIC, which means that if the bank goes out of business, then the government comes in and bails them out and will pay you off up to certain limits. So make sure you understand what those limits are. When you buy CDs through a brokerage firm, you can normally very easily diversify amongst many, many, many banks. So we literally have clients who have millions and millions of dollars in bank deposits, and every penny of it is insured by the FDIC. And then there are corporate bonds where you lend money to a company, could be any big company, and that company promises to pay you back the principal plus the interest. And as long as they don't default, they will. But if they do default, like they go out of business or they file for Chapter 11 bankruptcy, then you're a little bit in trouble, and hopefully you'll get back at least some of your money, if not all of it. Anyway, the strategy I want to give you is what we call a CD ladder or a bond ladder. I mentioned diversification before, and then I went right into stocks and bonds and real estate and that kind of thing. But there's another way you can diversify, which is diversifying over time. So instead of just saying, oh, I'm going to buy a 5-year CD or a 2-year CD, if you have $500,000, say, listen, I'm going to put $100,000 in a 6-month CD, $100,000 in a 12-month, an 18-month, a 24-month, a 30-month. You can break it up over time. Then, especially for retirees, they like having this money coming due on a regular basis. It's very predictable. People are always nervous. What if, right? No one knows what if may happen. And they want to have money that comes due from time to time. And so if you put, let's say, $100,000 in the CD and a year later you get your $100,000 back plus whatever interest payment, that liquidity event, getting that money back, gives you the opportunity to once again speak to your advisor or speak to your spouse or your kids and make a new decision. Let's pause and get the tax side of that. Ron, if someone buys a CD, puts in $100,000, gets out $100,000, and let's say makes, to keep it easy, makes $5,000 in interest income, what are the tax consequences of that?
Sure. It's taxable at their marginal tax rate. First in the States, if it's a U.S. investment, and then also in Israel, assuming that they're out of their 10-year exemption in the States. I'm sorry, out of their exemption in Israel. So they'll pay whatever tax that they pay to the States. Let's say it's 10%, 15%. The tax in Israel is 25%, and they'll pay the difference to Israel.
So just to clarify, because you're using very specific terms, I want to bring up a question people sometimes say is they say, well, what if, the example that I'm giving, Doug, I put in $100,000 and at the end of the day, I got $105,000. Isn't that a profit? So the answer to that is no.
No, it's interest income. It's interest income. It's not like a stock where you bought it at 5 and you sell it, let's say at 15, and you have a 10 profit that you're taxed at capital gains rates. Here with the CD, the difference is the interest that the bank is or the company is paying you.
Got it. So when you mentioned before, and maybe this is just a good chance for us to touch on this a little bit. First off, there are no changes in these rules that we're seeing to 2025, the way it works for people living in Israel, let's say, who have some investments in America and maybe some in Israel.
Correct. As far as we know right now.
Okay, surprise. Yes, if something changes, we'll have to do another webinar on that.
Correct.
So just clarify between capital gain. Let's just talk a basic investment portfolio between capital gains, which is like the example you gave. If you buy a stock for 5, you sell it for 15, that's a $10 profit. So that's a capital gain. Differentiate between that, dividends and interest, and how each country, Israel and the US, would tax those.
Sure. Let's start off with interest. Interest in the States, they tax you at marginal rates. So whatever marginal rate you're at, that's what you'll be taxed at. So it's at ordinary rates, anywhere from 10% to 37%.
So let me stop you there.
Between. Sure.
Most of the people that you work with, in other words, normal retirees in Israel, maybe they've retired here, they have a couple of $1 million in savings or in an IRA in America. Do they tend to be in a high tax bracket in the US?
Generally, no, but people that are more blessed with wealth, that have a lot of income, yeah. We definitely have clients that are in the 37% bracket that are very blessed with income.
So in those cases, we'd have to look more closely at whether building a portfolio focusing on interest income is the right way to go, as opposed to a different model.
Depends if tax is the main driver or if another variable is the main driver here.
Like growth, for example. Okay,
correct.
So good. So you mentioned about interest. Now, how about dividends?
Dividends. If they're regular dividends, the same thing as interest. If they're what we call qualified dividends, they are taxed at capital gain rates, which could be at 0, 15, or 20% in the States. All depends. If you're in a lower bracket, it could be as low as 0, or it could be at 15 or 20% for those qualified dividends. And most people we see generally do have qualified dividends and just a little bit of non-qualified dividends, but everyone is different. And the last one is capital gains. In the States, long-term capital gains are taxed at the same thing that I just said for qualified dividends, 0, 15, or 20%, depending on your bracket. And short-term capital gains, those that you own less than a year, are taxed at regular marginal rates, which can go anywhere from 10% to 37%. In Israel, if you have any of those types of income, they are taxed at 25%. We're talking about US income now. They're taxed at 25%. And for interest and dividends, US has first right to tax, and Israel will give you a credit for the taxes you pay to the United States. And for capital gains, because of the treaty, the first right to tax is in Israel, and the US has to give you a credit for your Israeli taxes you'd be paid on your US source income.
So let me touch on that, because sometimes people say, yeah, but I don't want to. I want to pay, my capital gains. I grew up in America. I bought the stocks in America. They're in America, and I'd like to pay it there. And I always tell them, you have to speak to your accountant about that. But how do you respond when people tell you that?
Well, that's very nice, but the Israeli tax authority will say the amount of tax that you pay to the United States on those capital gains is volunteering the tax, and we're not going to give you a credit for that.
Got it. So you'd say that's a poor idea in terms of
tax. That's double taxation. If you want to pay both countries, by all means.
Okay. And other than, let's say you don't do that, and I hope people listening learn, really important that there are rules about this. It's not a question of opinion where you feel like paying your taxes and you don't get to choose. There are rules about it. If you follow those rules, again, we're talking about basic brokerage accounts like that. Will people suffer from double taxation?
No.
Okay.
No, they just pay the higher of the two taxes. It's just like a piece of a cake that you slice up. One country gets the first slice, and the second country gets the remainder.
Great. Okay, so what I'd like to do is I just want to make people feel a little better, because we spoke now about inflation and interest rates and touched on taxes, but we'll talk more about taxes soon when Ron starts. But I just want to suggest that if you're concerned or you're finding in retirement that maybe things are a little bit tight, review your portfolio. But B, there's certainly always things you can do, whether you're going to focus on your spending, whether that's cutting spending, making your house more energy efficient, turning off the air conditioning when you leave the room, looking at senior citizen discounts. A lot of times, especially for Americans who make aliyah when they are retired, maybe their Hebrew isn't so good and they're just not participating in what it means to be retired here. There are lots and lots and lots of benefits for retirees, just like you knew when you were in America. Maybe you joined the AARP at one point because you loved all the discounts. There's a lot of things like that that are available in Israel. Speak to your friends, go to groups and say, what's available to me? Because, other than shopping smart and optimizing your transportation costs and, not buying a second car that you don't really need. And in fact, not even keeping a car if you don't need it. Cars incidentally are not an investment. They're just like a sink where all your money goes and gets flushed down. So, again, I own a car, so I'm not speaking against cars, but be aware that if you're not really a car user or a car driver, you don't want to be like this client I had once who literally kept her car, even though she had lost her license, but she kept it in the garage. She said, well, what if one day I need to drive someplace? I said, well, call a taxi, right? We have a very good taxi service here. There are plenty of ways that you can watch your spending without really affecting your lifestyle in any big way. I'm not suggesting that people go crazy. I'm just, talking about being careful about spending if it becomes an issue for you. And secondly, as people retire, a lot of times we've discovered, and a lot of companies are very open to people not fully retiring. You can continue to work. And you may say, oh, but what about my pension or my Social Security? You can talk to your financial professionals to figure out when to start claiming your Social Security or your pensions. And just by working, A, I think it's healthy psychologically, and B, it's certainly healthy financially to bring in a little bit of extra money. Those sorts of lifestyle changes are always available to you. And although today we're really talking about investments and taxes, I just think it's important to realize that there's a slew of changes you can make in your life, from cutting down the number of times a week you go to a restaurant, to reviewing the withdrawal rates from your investments, to paying down debts that you may have that are charging you a lot, or maybe even just paying down all your debts if possible. You don't want to be one of these people. And again, I get this a lot. Clients come to me well into their retirement and they say, Doug, I'm going to be buying a car, which already I mentioned before, I'm not a big fan of. And I'm thinking that maybe I should, I can get a loan, right? And then it's only going to cost me, X number of shekels per month. And I always tell them, well, very good, but why are you taking a loan for something when you have the money for it? You got to check out the debt that you have too. That's the other side of the investment equation. And finally, on this topic, and then we'll move on to, I think, the excitement, which is the geopolitical instability. But I think it's very important for people who are managing a portfolio. The last thing is make sure that you have enough liquidity. So I deal with this all the time. One of the worst cases I dealt with recently was a multi-million-dollar client who had to sell out his portfolio and take the money out. I said, why are you doing this? He goes, Doug, I don't have any money. I said, what are you talking about? You're a very, very wealthy couple. And he said to me, yeah, but all of our money is tied up in real estate. We don't have liquidity. I said, why don't you have liquidity? And there's a whole story, which is not really relevant to our discussion today, but make sure you have an emergency fund, not just, a few thousand shekels in the bank, but enough money to cover your expenses for at least 3 to 6 months. So it's available. Now you may say, yeah, but if I keep it in the bank, I earn so little. That's true. And I always tell people that's the cost of liquidity. That's the cost of safety. Ron, just to touch again on the tax point, when people keep money, let's say in their Israeli bank account, if it does earn any interest, how do they deal with that in terms of both their Israeli and American taxes?
There'll be withholding tax at source in the bank account, either at 15% or 25%, depending if it's linked to the CPI or not linked to the CPI. So Israel will just withdraw that. For people that are over 65, it could be that they won't have to pay tax. There's a certain exemption, and they'll give back the tax if that's applicable, and they do that automatically. And then on the U.S. return, you'll pay the U.S. whatever your marginal rate, less whatever Israeli tax you paid.
Okay, and you get a report from the bank that tells you in Israel.
There's a form 867. Sometimes you have to request it. Not all banks will send it to you automatically. If you have online access, you can just push a button, and they're generally available March 31st after the close of the year. So for 2024, it'll be available somewhere on or before March 31st of 2025.
Got it. And then you should these are often in Hebrew. So
Yep.
it's a
But
benefit
you
to
also,
working with.
a lot of times you can get this in English.
Oh, no kidding. Okay. I was
Yeah,
going to say that's why you need to work with an accountant in Israel, because he can read the Hebrew.
it's true. Not all do. Some do. Some of the banks do, and some of the banks don't.
Got it. Okay, let me just wrap up the section on investing here, just with a few things people need to focus on in 2025 concerning geopolitics. And again, I'm not going to give a political lesson nor a political harangue about what's going on. I just want to point out some of the things that a lot of the guys on Wall Street are talking about on a regular basis, because I really do think this could have an effect on many people's portfolios. And then I'll finish up by suggesting how I think I would deal with this. I think we can just literally start by looking at what countries we care about the most. I'm guessing that most people on this call care about Israel and America the most. America obviously is the world's largest economy, has a huge impact on what's going on, and their policies, not only what their central bank decides to do with interest rates, but their policies and the way they deal with the political challenges in the world will have a significant impact on every country in the world, including Israel. The nice thing about having investments in America is, you're kind of with the biggest player in on the field. So that's why a lot of Americans in Israel, in fact, a lot of people around the world, like to invest in America, because that's really where they want to keep their money. Now, again, I'm not getting to politics, and some people are happy with what's going on, some people are unhappy with what's going on, but the fact is that's the way America's set up. The next major player is China, right? So China's economic growth has been huge. Their trade policies are, especially vis-a-vis America, are really quite a challenge. And any action that they do can severely affect the global supply chains. Now, you may have seen during Corona, especially, that the global supply chains were completely messed up. And if you were, for example, doing renovations on your house, what you thought was going to be a $50,000 renovation turned into a $100,000 renovation because people couldn't get wood or aluminum or any of the commodities that they needed because the supply chains were all messed up. And so China is very, very involved in this, and they're able, A, to control a lot of this, and B, they're also affected by it because so much of what you and I use every day is made in China, as they say. Connected with that, of course, the names of the first few countries I'm listing now are things that are in the news every day, countries in the news every day. We have Russia, and Russia is a major exporter of oil and natural gas, and that's obviously been a little bit disrupted by the war with Ukraine, but not as much as we would think. Like you might have thought, again, it's very hard to talk about investing without getting into politics. And Ron, if you disagree with any of the politics, feel free. But I'm not trying to engage in that conversation. I just want to point out that Russia is a big player here. They can very easily disrupt the energy supplies, both themselves and by influencing other countries. In the same way, when they increase their attacks on Ukraine, Ukraine is really a central hub for global agricultural exports. And all that gets messed up with the war. All of these things are really creating a lot of pressure on the world economy, whether it's India, whether it's, sorry, I guess I probably should have listed this first for people in Israel, which is the Iranian threats, right? Which is not just an existential threat for us, but is a threat in terms of control of oil and their disdain of the Saudi Arabians, right, who also control a huge amount of OPEC oil, and the decisions that these two countries are making, not based on economics, but based on how much they hate or don't hate each other, will absolutely affect what's going on in the market. I'm not going to go into Japan and North Korea and Turkey and all these other countries. We could talk about that for hours. It's a great topic, and maybe we should do that another day. But the answer is, how do you deal with this? How do you deal in your portfolio with this? I don't suggest that you guess what's going to happen amongst all of these world powers and bet on that in a big way. If you want to bet on it in a little way, fine. But I had a client once who was a big economist, and I said to him, fine, I said, how come you work with me? I'm an investment advisor, but You're an economist. Don't you know everything? And he said, Doug, I look at the big picture of what's going on, but I literally have no idea how to handle my money. So I thought this was funny. So with him, I did just like I do with everyone else. I said, okay, let's start by figuring out how much money you need to have an emergency fund. And that's critical, especially today with the political instability. Definitely make sure you have cash available. Don't go down to your last penny. Don't say, oh, listen, I own a property. I could mortgage it and buy another property and leverage it out. Isn't that how all the rich real estate moguls made money? Yeah, maybe. A lot of them lost money that way too. But you cannot tie up all of your money. You need to maintain liquidity. Next, avoid emotional decisions. I tried to present this in a way that doesn't sound scary, but as I was saying it, I realized, well, some of this stuff is scary. And maybe someone's going to, finish this and go, oh my gosh, I better sell. Don't be so quick, right? Go slow, invest for the long term. We've had these sort of problems before. It's not the first time the world has been kind of shaken up. Not the first time we've had leaders who were quite dynamic, let's say, in the way they express their opinions that makes people scared. And don't follow the herd, right? Focus on what's right for you, develop your financial plan, and stick with that plan. And that applies to your investments and as well as planning your taxes. And the last thing I just want to say is watch out for cyber threats because given especially some of the countries I mentioned, Russia and China, there really is a risk here. You need to watch out for emails that you don't recommend. You need to change your passwords on a regular basis. You need to watch out when someone calls you and says, hi, I'm calling from Microsoft. Your computer has a bug. Please help me log in and I will fix it for you. You need to watch out for identity theft. A good solution there is to freeze your credit records with the 3 credit agencies in America. There's a lot that you can do to protect yourself from cyber threats. If you don't know what to do, feel free to get in touch with us. We'll be happy to send you information on that. And certainly a lot of these ideas and the solutions will be listed in the written copy of the 2025 financial guide, again, meant specifically for retirees. You can get it even if you're not retired. Just make sure you sign up for our newsletter at profile-financial.com. I'm going to wrap it up. I think I've covered a lot today, and I want to really turn this over now because we need to talk about what's going on in the world of taxes in 2025. So, Ron, I'm handing over the baton to you.
Got it. So let's talk about tax changes. We're going to talk about the U.S. side. At the end of 2017, Congress enacted a huge amount of tax changes, and they are effective through the end of 2025, both income tax and also estate tax. Now, one of the interesting things that we've been waiting for was the results of this election, because if we had Democrats in the White House or in Congress in the Senate, probably the tax law would have gone one way. And now that we have Republicans, more likely than not, we can't say this for sure, but our guess is that they're probably going to somehow extend what we had that would end at the end of 2025 because it was a Republican president and Congress that passed these tax changes that ended in 2025 back at the end of 2017. First, let's talk about estate tax. That was supposed to change at the end of 2025 and go back to roughly about $7 million per spouse. In 2025, the estate exemption is a hair under $14 million per spouse. That's $13,990,000 per spouse. And our guess, and we can't say for sure, and we'll find out after the inauguration and the upcoming months, that we'll see what Congress and the Senate does to change or to keep. We'll have to see. Income tax, same thing. It was supposed to go back to what was the law in 2017 prior to the tax change. And it looks like, but we don't know for sure, that more likely than not, that things are going to be continued. We have a number of campaign promises that were made during the election season. We don't know if those things are actually going to come to fruition, because it's one thing to be a candidate. It's another thing to pass legislation, because you actually have to pay. You actually have to pay for what you're promising. And so something has to give. If you're going to give a break on one side, you're going to increase taxes or decrease an exemption or something along the lines on the other side. for example, there's one proposal that doesn't really apply to us in Israel because we have the treaty anyways to exempt Social Security and to be tax-free, but because of the treaty between the U.S. and Israel, in any case, both in the United States and Israel, for people that live here, our Social Security income is tax-free.
Can I just comment on that?
Sure.
A lot of times I meet with clients, especially people who maybe are new here, and they still work with their U.S. accountant. And when we look at their tax return, we see that the U.S. accountant was charging tax on their Social Security. And I say,
Yeah.
why are you doing that? Of course, the client has no idea. And it's not that the accountant's a bad accountant. He just doesn't have any clients who live in Israel. So he has no idea even to think about this question. It's one of the, I mean, there's a lot of details being a cross-border client, but even if you're going to stick with your U.S. accountant, at least have a meeting with an accountant in Israel to make sure that the guy you're working with or the company you're working with in the States knows what they're doing, because you don't want to be the unique overseas client for your accountant in America. You want to be just like everyone else and treated just like everyone else. Sorry.
No, it's an amazing benefit. And actually, within the last couple of days, I just looked at a return of somebody that were amending for past years that they stayed with their U.S. accountant, and we took a look at the return and went, "Well, you paid extra tax, and we're getting them a lot of money back in refunds for doing 3 years of back returns." So amazing benefit, and definitely people should be aware of it.
Good catch. All right. Sorry.
Yeah. No, it was pretty amazing. One of the things that I do want to talk about is required minimum distributions. That every year in the last couple of years, they keep pushing it up. It was at 70.5. It's been pushed up to 72, and it's been pushed up to 73, depending on the year that you were born. You have to take required minimum distributions. And one thing that people may or may not know about is something called a QCD, a qualified charitable distribution. In 2025, each spouse from their IRA can give up to $105,000, and that will not show up on their U.S. return. It's an amazing benefit. The money has to go directly to a charity. It cannot go to a donor advised fund. There are other limitations, so you have to make sure that you're abiding by the criteria, but it's an amazing benefit for those who are over 70.5. And again, if you have to take required minimum distribution, either if you're over 70.5 or 72 or 73, depending on the year you were born, you should think twice about doing this. It's very, very important.
Yeah, we found a lot of people like that. In fact, when they have an IRA with us, so we give them a checkbook and to say, listen, you can send a check to your charity, to your favorite charity, directly.
Amazing.
It makes it very easy for them to get this benefit. And just to be clear, let's say that the person gives $100,000 from his IRA to a charity. How much is he saving in terms of taxes?
His marginal rate, let's say he's in 37% bracket, he's saving $37,000.
Right.
Absolutely
that's why
incredible.
This is a lot of money. This is a real game changer.
You don't get the charitable deduction, but on the flip side, it doesn't show up in income. So it's probably one of my favorite benefits that's out there that people should take advantage of.
We should make a list of Ron's favorite benefits.
Exactly. I also want to talk about giving to appreciated stock to either U.S. or Israeli charities. In this last year, the Israeli Tax Authority gave a ruling that this is what people used to do in the old country, and they would give appreciated stock to charity. However, prior to this ruling, if you gave appreciated stock to a charity, they would consider it as a virtual sale. So, but it must go to an Israeli charity. If you give it to a U.S. charity and you're outside of your 10-year exemption, that is going to be considered a virtual sale for Israeli purposes. So it is extremely important that you get proper advice. Sometimes it makes sense to give appreciated stock to a U.S. charity. Sometimes it makes sense to give appreciated stock to an Israeli charity. It all depends on your circumstances. Must get proper advice. I cannot stress it enough. I have a number of people that have heard about it and were about to give And in their particular situation, it did not make sense. So each person must get proper advice. And I know you're dealing with that a lot
Yeah, we
as
deal with
well,
a
Doug.
lot, especially now people who they own some high tech stocks that did fantastically, and they have hundreds of thousands or sometimes millions of dollars of profit in their portfolio, and they're very skewed. The portfolio is really it's super heavy weighted in one stock, and they're nervous, legitimately, because no one knows what's going to happen. But they don't want to sell it because they're going to have a huge tax. So they say, listen, let me give away a piece of that stock. And literally, they just fill out it's very simple, right? They just fill out a form. We transfer 100 shares, 500 shares, 1,000 shares of that stock to a charity, and the charity sells it, that day. And the client gets two benefits, right? Two tax benefits. Can you explain that?
Sure. If it's applicable, again, it all depends. It's a credit in Israel. So for every 100 shekels you give, you get 35 shekels off your tax bill, subject to certain limits. And the United States, it's an itemized deduction, assuming that you're able to itemize.
Right. And the fact that you're not selling the stock means that you don't
Correct.
pay capital gains tax, right?
100%.
It just leaves your portfolio. You never sell it. There's no reporting on that stock because you didn't sell it, and that was the end of it.
Correct. Correct.
Yeah, and from a portfolio design point of view, you could then, if you still like the company, you could buy it back, right? It's nothing stopping you from buying it back, but at least you've gotten rid of a huge amount of capital gains tax that you would otherwise
Correct.
have to pay.
Correct. Okay, let's talk about some changes in 2025. For example, the gift tax exemption was 18,000 in 2024. It jumps up to 19,000. The standard deduction jumps up about $800 for married filing jointly to $30,000. For head of household to 22,500, it jumps up a couple $100 as well. And also for single or married filing separately, it's at $15,000. And if you're 65 and older, per spouse that's over that amount, you get an extra $1,600 of standard deduction. So it's a little bit, but every little bit helps.
Right. This could affect, and you're saying in 2025, these changes take place. So for people who are careful with their spending, this is actually a little more money in their pocket.
Correct, a little bit. It's supposed to be adjustments for inflation and the consumer price index. So hopefully it does help out. I'm not sure how much, but every little bit helps. Okay, so let's talk about one of the hot topics that the IRS has started to really look at, and that's cryptocurrency. For people that own cryptocurrency, if they sell stock, there is a question, and they have been getting much, much more aggressive in looking for and enforcing people reporting their crypto. It's like a capital gain when they sell that crypto. So it's so crucial that you have proper records and you tell your accountant that you have crypto and you have sold it when you have sold it, because leaving it off the tax return is a big no-no. You absolutely want to include it, just like when you include your capital gains on the sales of securities.
Got it. And does the crypto bank, whoever you're dealing with, they provide a 1099?
Some of them do, and some of them don't.
Yeah.
They're getting better, but not all of them do. And a lot of them will provide, when you sell it, cost basis information, but unfortunately, there are a good number that do not. And you're going to have to compile it if they do not provide it. So it's something to keep an eye out if you're in that situation. Just want to give a couple tax tips for 2025. The first is, if you're over the estate limit, or if you're not, consider giving the 19,000 per donee every year. The check needs to clear by the end of the year, and it's 19,000 for 2025. Again, 18,000 for 2024. Very, very important. Consider giving the qualified stock to charities. Consider giving appreciated stocks to charities. Let's go back. The first one I meant is giving your IRA to a charity. And one of the other things that I want to talk about is where people say, well, how can I help myself tax-wise? Now, this may not make sense from a financial point of view. You need to talk to your financial advisor. if you're looking to reduce your income, you may want to consider investing in growth stocks. You can explain what growth stocks are, Doug, but they essentially don't produce any income. So if you need the income, this is not going to help you. But one of the strategies is if the stocks don't have any dividends and you wait to recognize the capital gain, you effectively drive down your taxable income.
Yeah, I think that's an important point. You have to look at your overall picture, but a lot of times people will have a diversified portfolio, and some of the positions will be growth stocks. Again, that means a company that you're buying, and most likely all of the income or much of the profits that the company has, the company itself reinvests in itself to do more research and development or to expand, and that just helps the company grow. So you're not looking for the quarterly dividend from this. Rather, you're looking for growth in the stock, and you'll eventually sell it. Compare that to someone who says, "Oh, I'd like to, I need some supplement to my monthly income," and he puts money into a dividend-paying ETF, let's say an exchange-traded fund, and every month he gets a little money into his account, and that he can use to supplement his income. When you do that, you just need to look, talk to your accountant or talk to your advisor and your accountant, and see what are the numbers here. And don't forget that these are marginal rates, which I think is important. Meaning if you're not sure and you want some income, and if some of your income is in the lower rate and a little bit's in the higher rate, it may not be a big deal. So you don't have to panic if all of a sudden you're going to have to pay a little bit in tax.
Okay. And some of the other tips are consider giving to charity either in Israel or in America, and you're going to need to consult your advisor seeing what makes most sense. And on your Israeli return, you should make sure you give your charitable receipts and keep your charitable receipts, because in order to claim the deduction, you must have the receipts. You cannot just tell the Israeli tax authority, I gave 100 shekels to such and such organization. You must attach that receipt to your tax return. Otherwise, you will not get the deduction. Very, very important. And if you have management fees from a brokerage account, you can take that as a deduction on your Israeli return.
Wow, those are a lot. That's a lot. I think we really covered a lot. Actually, we've been kind of long. We've gotten a whole lot of questions that came in. I just want to stress a lot of the questions I noticed are questions that are covered in the 2025 financial survival guide. So make sure that you sign up so that you'll get a copy of that, because there's zero chance we will cover all of the questions right now. If for the shorter questions, if they're tax questions, Ron and his team will try to get back to you hopefully within the next few days with a brief response. If it's investment-related questions, then we'll try to get back to you. If there are more in-depth questions, then someone on our team will get in touch with you to see if you would like to schedule a consultation, if it's really more detailed about your situation. But Ron, just if we have another minute now.
Sure.
One of the questions which I thought just people are worried about all the time, they always hear us talk about FBAR and FATCA, and there were certain suggestions, I don't know if they were campaign promises, and they asked, what are the updates? Anything I should know for 2025 regarding FBAR and FATCA? So what do you think?
So far, nothing major on those fronts. We will have to wait and see.
Okay, could you
You always
comment?
have to report. You always have to continue reporting on your FBAR and potentially on an 8938 and your U.S. return, the highest balance in your in your non-U.S. bank accounts, such as in Israel, your investment accounts, your non-U.S. investment accounts, your employee benefit accounts, because like Kupat Gimel, Keren Ishtamot, Bituch Menhalim, and Keren Pensia, and if you have signature authority on someone else's account. For example, if you're a volunteer for a nonprofit organization and you get to, these days you don't sign checks, but you get to move the money, you have to include that on your FBAR as an account that you have signature authority. It's not your money, but you have to include that.
Wow, that's kind of everything.
Yeah, it is, particularly for folks who live here. Very applicable.
Right, and it's a pretty severe penalty if you don't file your FBAR, right?
Correct. Let's not go there.
Let's not go there. We won't leave you on a sour note.
No.
Yeah, let me answer. There was one question that just came up on the investment side, and then we'll wrap it up. So someone just pointed out, how can I protect my investments if interest rates continue to fall? So I'm assuming that what you mean is if you're living off the interest from your investments, like CDs. So one of the unusual things we've seen recently is what's called an inverted yield curve. What does that mean? Normally, when people buy, let's say, a CD, they expect that a short-term CD will pay a lower interest rate than a long-term CD. And it makes sense. You say, listen, if I'm willing to tie up my money for longer, I should get paid a higher interest rate. These days, and recently, it's been inverted, meaning shorter-term CDs were paying higher interest rates than longer-term CDs. So what do people do? Everyone's greedy, reasonably, right? We all like to make a little more money. So people say, oh, I'll just buy a 3-month or a 6-month CD because I can get a higher yield than a 12-month CD. And you have to ask yourself the question, why are the banks inverting the yield curve? Why is it that the longer term CDs are paying less? It's because the banks think that interest rates are going down. So they don't mind paying you a little bit more on a shorter term CD because their plan is when that matures and you roll it over, they're going to pay you a lot less. So the answer to your question is, what do I do if interest rates continue to fall, or if I think interest rates are going to continue to fall? I think the answer to that is consider laddering out your CDs, go a little bit longer by slightly longer term. It's true, you may get a little less yield, but that's the trade-off. That's protecting you. You're always paying for some kind of protection, and this is one way to protect you. Now, of course, this should all be done in the context of a well-diversified portfolio. Maybe at the same time you have some growth investments and some other income investments. But the model of saying to yourself, I'm not going to just keep all my money in a short-term CD is a good model, even if those short-term rates are higher than the longer-term rates, because as you can see, you might be penny wise and pound foolish, and you don't want to be that guy. All right, let's wrap it up here. There's a lot more questions to go through. I just think we've really covered a lot today. Ron, in the last few seconds, just tell people how they could best contact you in general if they need to have someone handle their taxes.
Sure. Ron at Aboulafia, that's ABOULAFIA.co.il, or 02-629-4272.
Okay, now say the number again, just nice and slow.
02-629-4272.
Great.
And how do they get in touch with you?
I'm Doug Goldstein with Profile Investments. I deal with people who live in Israel who have U.S. brokerage and IRA accounts. You can reach us at profile-financial.com. That's our website. That, by the way, is where you need to go to sign up for the newsletter, so you'll get a copy of the 2025 financial guide that covers a lot of what we discussed today and more. But not everything, actually. Some of the stuff we covered today is not in the guide, so I'm glad you stayed through the end. You can always email me directly to Doug, D-O-U-G, at profile-financial.com. And finally, feel free to call the office at 02-624-2788 if you have any specific questions. Thank you all. This was Ron, I think a longer but more in-depth webinar than we normally do, and I hope it was useful for you. Please let your friends know, and we look forward to seeing you next time.
Thanks for joining us.